Welcome, learner. Today we're doing a deep dive that really needs some focus. We're looking right inside the financial engine of a major real estate company during, well, what was clearly a standout quarter, Q3 2025.
That's right.
They've got a good stack of material, and we're concentrating completely on the opening remarks from the CFO, Scott Wallers.
Yep. And when a company puts up record numbers like this, people immediately want to know how. Our job here is really financial synthesis, taking those prepared remarks and making sense of them for you.
We're not just listing numbers.
No, definitely not. We're looking at the execution, the discipline, and really how they're managing to grow and become more efficient while juggling acquisitions and planning this huge merger.
Exactly. We're hunting for the why behind the what. The CFO said Q3 was the strongest third quarter ever. So, okay, how? Was it just the market lifting them up, or did they actually make structural improvements?
That's what we're digging into.
Yeah.
Okay, let's start big picture. Because the CFO kicked things off by saying, look, we set a bunch of new records, financial, operational, strongest Q3 they've ever had. Market share, revenue, profit, cash flow, all hitting new highs for the period.
And the number one metric, the place you have to start, is revenue. $1.85 billion for the third quarter.
Which is a massive jump, right?
Yeah.
Like 23.6% year over year.
It is, and in the real estate world, especially with some of the headwinds we've seen, that kind of top-line growth makes you ask questions. Is it sustainable, or did they just buy that growth?
And Wallers tackled that straight away. He broke down the organic versus the inorganic growth. So yeah, M&A, the acquisitions definitely boosted that 23.6%.
Sure.
But he made a point of saying, even if you strip out all the companies they bought over the last year, the core business,
Right.
their original platform, still grew revenue by 11%. Organically. And that 11% organic figure, that's kind of the health check for the core platform, isn't it?
Totally.
It tells you the agents they already had using their tech, their systems, they're actually doing more business than last year. It suggests, real productivity gains, that the platform itself is working well. That's super valuable for investors. It means the engine is running strong, separate from just buying new parts.
And you see that engine strength in the transaction numbers, too.
Yeah.
Total transactions were up 21.5% year over year. Tracks pretty closely with the revenue.
Mm-hmm.
But again, the core number, organic transactions up 6.6%.
Right. And this is where the market outperformance story really shines. You have to put that 6.6% organic transaction growth next to the overall market.
Which is only up, what?
Only 2%. So their core business transaction volume grew more than 3 times faster than the market average. That difference, that's probably the clearest sign of their competitive strength in the whole report. They are actively taking share, no doubt about it.
And yeah, that flows right into the market share number itself. The CFO said they hit 5.63% market share in Q3.
Which is up 83 basis points from Q3 last year.
83 basis points. I mean, for perspective, that sounds small, but in this fragmented industry.
It's huge. It's absolutely huge. Think about it. Gaining almost a full percentage point of market share year over year, that means they're grabbing a massive slice of any business that's changing hands between brokerages. It's not just slow growth. It's really aggressive share capture, probably driven by getting and keeping those top agents.
And the CFO added a bit of important context, didn't he, for people tracking quarter to quarter. He mentioned the seasonality caveat.
Right. He pointed out that, 5.63% is a record for Q3, but it's typically a bit lower than Q2.
What is that?
It's about the market mix. He said the West Coast markets, which are a big part of their overall revenue, usually peak in Q2. So Q3, capturing a late summer, early fall, naturally sees a slight dip compared to Q2, even if the year-on-year growth is fantastic. It's just managing expectations, explaining the normal rhythm of the business, good transparency.
Okay, so we've got the volume picture. Let's shift to the value side. Gross transaction value, GTV, that came in at $70.7 billion for Q3.
Yep, up 22.5% year over year. And like you said before, that tracks almost exactly with the 21.5% increase in total transactions.
Which suggests?
Well, it suggests that the average price of the homes they sold didn't massively swing the needle on its own. The growth came mostly from doing more deals. But the real interesting part is when you look at the average selling price, the ASP.
Okay.
Because on consolidated basis, looking at the whole company, the ASP only went up by about 1%. Pretty modest.
Right. If you stop there, you'd think prices were pretty flat across their network.
Exactly. But then Wallers gave that crucial bit of insight, the M&A effect. He clarified that if you look only at the organic business, the ASP increase was actually closer to 5%.
Ah, okay. So that's a big difference. 1% overall versus 5% organic. What's causing that gap?
It's the acquisitions they made over the past year. This is really important for you, the learner, to grasp strategically. They made a deliberate choice to buy companies, expand their footprint, great for scale.
What?
But, as Waller's explained, these newly acquired businesses tend to operate in markets where the average home price is lower than in their original, core, often higher value market.
Right. So if your main business sells $1 million homes and you buy a company that averages $500 K homes, your overall average gets pulled down.
Precisely. Even if those million-dollar home prices are actually going up by that 5% organically.
So they're accepting a lower headline ASP number.
Yeah, they're accepting that dilution, that 4-point difference between the organic 5% and the consolidated 1%, as a trade-off for getting bigger, getting into new areas. It shows they're thinking long-term about market penetration, not just chasing the highest possible average price right now. The core is healthy. That 5% organic price growth proves it. But the blended number tells a story about strategic expansion.
It's a classic strategic choice, really. Sacrifice maybe a vanity metric in the short term for long-term scale and geographic diversity. And it confirms the core is firing on all cylinders. Volume up 6.6%, price up 5%. Okay, let's pivot to the bottom line, profitability. Because this is where that theme of operational discipline really comes through. The CFO flagged a key ratio, commissions and related expenses, as a percentage of revenue.
Right, and that improved. It came down to 81.44%.
Which was down from 82.17% last year, so an improvement of 73 basis points.
And look, in brokerage, tightening that commission ratio by nearly 0.75%, that's hard work. That's significant.
So how they do it?
Well, Waller's gave a lot of credit to the Christie's international real estate acquisition they did back in January.
Right.
Apparently, Christie's just operates with better, more favorable margins structurally. So buying them immediately helped the overall company average. That's a clear M&A synergy win, literally buying profitability.
But it wasn't just Christie's, was it?
No, and he made sure to point that out. He said even if you strip out M&A effects, the company's organic commission expense ratio still got better by 20 basis points compared to last year.
Okay, so 20 basis points organically. That shows they're also tightening things up internally.
Exactly. It suggests better cost management, maybe different agent structures or retention deals within the core business. So they're getting a boost from Christie's, and they're managing their existing costs better, kind of a double win on the margin front.
Yeah, there's always this tension with agent splits, right? Top agents bring in the business, but they usually demand higher commission splits, which can squeeze those margins.
Yep. And Waller's addressed that head on. He acknowledged that trend. Top producers are gaining share. And yes, they generally get higher splits.
So why is the company okay with that?
His explanation focused on GCI gross commission income. We should probably define that quickly for you. GCI is the total commission dollars an agent brings in before the split between the agent and the company.
Gotcha.
So the company's view is, while the percentage they keep might be a bit lower for these top agents, the total dollar amount they keep from that agent's massive GCI is actually much higher.
So it's about absolute dollars, not just the percentage rate?
Precisely. They'd rather have, say, 18% of $1 million in GCI than 20% of $500,000. The total dollars retained are greater, even if the margin rate looks slightly lower on that specific agent's production.
That makes sense. Focus on maximizing the profit dollars from the most productive assets, the top agents.
Exactly. It's about driving aggregate dollar profitability.
And all this focus on profitability led to some pretty eye-popping adjusted EBITDA numbers. $93.6 million.
Yeah, which was up a massive 80% from the $52 million they did in Q3 last year.
80%. That's enormous growth.
It is, and Waller's flagged it as a new record-adjusted EBITDA for any third quarter, and actually the second best quarter they've ever had overall. But, the question is always, how much of that 80% jump is real operational leverage versus just, acquisition accounting?
And what did he say were the drivers?
He pointed to three main things. First, that strong revenue growth we already talked about. Second, the tight grip on operating expenses. We'll get more into that. And third, a really strong contribution from their mortgage joint venture. Said it was its most profitable quarter ever.
Ah, the ancillary services piece. Yeah. That JV strategy seems to be paying off.
It does. That mortgage JV, which now includes the one they got with Christie's, its results show up in that equity in income of unconsolidated entities line.
And that line item contributed.
A positive $3 million for the quarter. Now, okay, $3 million isn't huge compared to $93 million in EBITDA, but it's significant strategically. It shows that vertical integration into mortgage is working, it's profitable, And hitting records means they're executing well on that diversification plan. It helps smooth out the reliance on just brokerage commissions.
Okay, let's drill down on that cost control side then. The operating expenses, or OPEX. The non-GAAP number was $252 million.
Which was up from $215 million last year. So yeah, expenses did go up.
Okay.
But as the CFO immediately pointed out, that increase was mostly and predictably from the acquisitions. You buy Christie's, you buy Washington Fine Properties, you inherit their running costs. That's expected.
The really important number, though, was the organic OPEX growth, right?
Exactly. That's the one Waller's emphasized. He said if you exclude M&A, the growth in their core, organic non-GAAP OPEX, was kept really tight, only about 3.5%.
Okay, 3.5% organic cost growth compared to 11% organic revenue growth.
That's the magic number right there. That's operational leverage. They're growing the core business revenue 3 times faster than the core costs needed to support it. That is pure financial discipline in action. It shows they're sticking to that plan of low single-digit cost growth even while the top line is booming.
Now, there was a big unusual item hitting the books this quarter related to that huge Anywhere real estate merger they announced.
Right. The transaction costs. They spent $7.5 million, mostly on lawyers and bankers, just related to getting that deal announced.
And how did they account for that? Because it's not really an operational cost.
No, it's a one-off. So for transparency, the CFO said they created a brand new line item on the income statement, Anywhere merger transaction and integration expenses. Super specific.
And why separate it out so clearly?
It's crucial for you, the learner, following the story. These are one-time costs. They don't reflect how the actual day-to-day business is running. So Waller's confirmed that $7.5 million was explicitly excluded from their non-GAAP OPEX and adjusted EBITDA calculations. It keeps the picture of underlying performance clean. Good practice.
Okay, what about stock-based compensation, SBC? That can sometimes confuse things.
Yeah, he touched on that. Said SBC was basically in line with what they'd guided, but he reminded everyone that the SBC numbers looked a bit high in Q2, Q3, and would again in Q4 of 2025.
And the reason for that temporary bump?
It's purely accounting. They changed how they grant employee equity, these restricted stock units or RSUs, and the accounting rules put a higher value on them temporarily, which inflates the non-cash expense. So he set the expectation, expect similar levels in Q4, but then it should naturally come down in 2026 as those specific grants vest. It's not permanent cost inflation, just a temporary accounting thing.
Got it. So putting it all together, the final GAAP net result, the bottom line number after all the rules, was actually a small loss, right? A GAAP net loss of $4.6 million.
Yes, but again, that headline is misleading without the context, and Waller's provided it. He said, look, if you back out that $7.5 million in one-off Anywhere deal costs,
which they specifically isolated.
Exactly. Then the company would have actually posted a positive net income of $2.9 million. So operationally, the core business was profitable on a GAAP basis. It was just those merger-related costs that tipped the final number slightly negative.
Okay. Let's talk cash, because the free cash flow, XCF, sounds like it was incredibly strong.
It really was. They generated $73.6 million in FCF. That's a new record for any third quarter. And it's more than double the $32.8 million they generated in Q3 last year. Massive improvement.
Wow.
Yeah. And he added some useful context comparing it to Q2. Q2's FCF looked a bit lower, but that was because they made a final $29 million payment for that class action settlement in Q2, so the underlying Q3 performance looks even stronger.
But he also warned about seasonality again, right?
Yes, very important. Q2 and Q3 are usually the big cash generation quarters in real estate. He cautioned that everyone should expect lower FCF levels in Q4 and Q1, just due to the normal seasonal slowdown.
So what did they do with all this record Q3 cash flow? This seems strategically important.
It was a really strong signal about discipline. They took that cash and paid off the entire $50 million balance they had outstanding on their revolver, their short-term credit line.
Which they'd originally drawn down for the Christie's deal.
Exactly. They used it to fund the cash part of that purchase. So paying it all back now means they ended Q3 with $170 million in cash on hand and, crucially, zero balance on that revolver.
Wiping the slate clean on short-term debt and building up cash just before they potentially take on a huge amount of debt with the Anywhere merger. That feels deliberate.
Oh, absolutely. It's textbook de-risking. Maximize your cash. Eliminate near-term debt obligations. You're building the strongest possible financial base before a massive, potentially debt-heavy integration project. It's foundational for making that merger work smoothly in 2026. He also mentioned the share count. Basic weighted average was 566 million shares, important for EPS calcs later.
Okay, let's wrap up with the look forward. What did the CFO project for the rest of 2025? Starting with Q4 guidance, and these numbers should reflect that seasonality he warned about.
They do. For the fourth quarter, Waller's guided revenue to a range of $1.59 billion to $1.69 billion,
Okay.
and adjusted EBITDA expected between $35 million and $49 million. So yeah, a significant sequential drop from Q3's record $93.6 million, but like you said, that's expected with fewer closings happening late in the year. The share count is expected to tick up just a tiny bit, 571 to 574 million shares.
But the real exclamation point in the guidance section reinforcing that whole discipline theme was about the full-year operating expenses, wasn't it? That triple down on efficiency.
Yeah, this was pretty impressive. The CFO announced they were lowering their full year 2025 OPEX estimate again. The new target range is $1 billion to $1.05 billion.
And they already lowered it once this year.
Right. So this new target means they've now cut a total of $34 million from the midpoint of their original guidance back at the start of the year. But here's the kicker.
You won.
Waller specifically said this new lower estimate already includes about $7 million in operating costs they expect to absorb this year from 4 smaller acquisitions they just closed in Q3.
Wow. So they absorbed $7 million in new, unexpected costs from recent deals and still managed to lower the overall full-year expense target.
Exactly. That's the proof point. It shows their cost control isn't just talk, it's actively working, even offsetting new costs coming in the door. It speaks volumes about a company-wide focus on finding efficiencies everywhere, keeping that organic OPEX growth nailed down.
And all is control, the margin gains, the OPEX discipline, the JV kicking, and it all feeds into that longer-term profitability promise they made, right?
Correct. Waller's confirmed they're still firmly on track to deliver that extra $50 million to $75 million in adjusted EBITDA improvement they've been talking about. And critically, he reiterated they still expect to hit at least $50 million of that improvement realized by 2026. They're basically locking in today's wins like that 3.5% organic OPEX growth to guarantee structural profit gains down the road. The roadmap is being executed. #outro.
So we just unpacked a really detailed financial picture for Q3 2025, all through the CFO's eyes. And the story wasn't just about a hot market. It was about deliberate, measurable financial discipline, improving margins by 73 basis points while juggling acquisitions and merger planning. That takes serious control.
Yeah, the key takeaway for you, the learner, has to be that successful execution on 2 fronts. They used M&A smartly, like with Christie's, for an immediate margin boost. And they were incredibly disciplined in the core business, that 20 basis points organic margin improvement, holding organic OPEX growth to just 3.5% while revenue grew 11%. That's real leverage. That's what gets the market's attention.
Plus, leveraging those other businesses, like the mortgage JV hitting records, and using that fantastic cash flow not just to sit on it, but to actively strengthen the balance sheet, paying off that $50 million in revolver debt.
And that specific action, paying down the debt, ties right into our final thought for you to chew on. The CFO made a point of saying they entered Q4 with $170 million cash, 0 short-term debt. Okay, now think about the huge multi-billion-dollar debt load coming with the Anywhere merger next year. How absolutely critical is this aggressive cost-cutting and cash hoarding right now to make that integration survivable, let alone successful? And maybe more pointedly, how quickly will this cash pile allow them to start paying down that massive new debt load once the deal closes in 2026? That preparation, that strategic tension, that's really the core story to watch going forward.